Hello everyone and welcome to the October edition of our monthly fixed income update. Let's dive straight into what shaped the markets this month. The India's G-Sec yield curve in October has shown a slight bear-steepening pattern. Short end and ultra long end yields rose while mid-tenor stayed flat. This change in the shape of the yield curve indicates delayed rate cut expectations as anecdotal evidence supports strong growth at least in short term, and there is a rise of fiscal pressures in medium term. Liquidity started in surplus but tightened after tax outflows and FX intervention by central bank to stabilize the rupee post-FOMC. This has given rise to expectations of OMO purchases by central bank if tightness persists. However, as CRR cuts continue to aid transmission, we think any OMO purchases may only be introduced after the last tranche of the CRR cut due at November end. The rupee weakened against the dollar after FOMC meet, driven by the global dollar strength. RBI stepped in aggressively, pulling INR forward premiums back, reflecting intervention and lower US rate expectations. The big global event was the FOMC meet on October 20th and 29th. The Fed delivered its second consecutive 25 basis point cut, bringing the Fed target rate to 3.75 to 4%. But there is a twist. Fed Chair Powell said a December cut, which was largely expected by market, is far from a foregone conclusion. The minutes reveal sharp divergence in some members' expectation. Many of them wanted a pause, others pushed for a deeper cut. And the dot plot is still scattered, signaling uncertainty. Another key move was Fed's announcement on the end of the quantitative tightening. Now it will reinvest maturing agency MBS proceeds into T-bills to ease liquidity. US yields reacted with slight steepening. The 2-year closed near 3.6%. The 10-year closed near 4.1%. Markets trimmed the December cut odds to 60% from 90% before the policy. Meanwhile, US data stayed mixed. Private payrolls softened. Unemployment ticked up, but consumer spending held firm. Core PCE hovered near 2.9%, with tariffs keeping good inflation sticky. Back home inflation collapsed at 1.5% last month. The headline CPI, which is to be announced next week, is likely near or lower 0.5% year on year for the month of October. This is largely due to food inflation, lower food inflation, and GST cuts. Core inflation may stay above 4% for some time. Growth outlook remains steady at 6.8% for FY26. Inflation forecasts have seen persistent downward revision this year. Looking ahead, ultra-low inflation combined with RBI's accommodative undertone keep hopes for a December cut alive. What we are witnessing right now is divergence between the policy intent and policy space. In its last policy, RBI signaled some room for the easing. However, the monetary policy minutes later clarified that subdued inflation provides room for policy action, but there is no urgency to cut rates. This has left markets guessing, making December meeting a finely balanced call. While the growth inflation matrix remain the key input for the policy, our attention now is on INR movement, central bank's FX market operations, and its influence on liquidity. A soft CPI print alone is unlikely to change this focus. We view a 25 basis cut in December monetary policy meet as a possibility, but it may not be a major determinant of long-term yields, which are more sensitive now to fiscal dynamics, starting with next year's budget forecast. An evolving factor is employment data in US. If deeper rate cuts materialize there, it could create additional space for the RBI to ease further. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.